Hey traders, Alex Ong here, and in this video I want to talk to you about how you can get the best out of our service, the Money File. Now, the Money File is a weekly report where we bring you all of our trade ideas for the week ahead. And basically what I want to do is really go into detail about how you can utilize those trade ideas, because there are going to be some instances where the technical setup is already there. So we, on the Friday when we start looking at the charts and preparing the reports, we can give you the levels that we are looking to enter at, where we're looking to exit at, and all of that kind of good stuff. But then there are going to be other occasions when the setup isn't quite there. So we've identified a support or a resistance level, but the market hasn't quite got there yet. And because it hasn't got there, we aren't able to provide you the levels that we're going to get in at. So in this video, I just want to talk to you about a few of these sort of entry and exit techniques that we use for the trades that we're going to be presenting to you all. Okay, now, the first thing to remember is that all of the trades that we will be presenting in the Money File, all of the trades that we take, are always from a support or a resistance level. All right, so we're always looking to, either buy from a support level or sell from a resistance level. Well, 90% of the time. Okay, so there are sort of two primary setups that we use for the trades that we enter. There are a couple of trend continuation setups that we look at where the market has already reacted to a level, and we're looking to add to our positions. And we'll talk to you about that in this video as well. But let's start off by talking about the reactions to support or resistance levels. And what I'm going to do is I'm going to start by giving you some examples of some recent trades that we've taken and the way that we've obviously applied these entry techniques. So the first one is this one on the pound Aussie here. Now on the pound Aussie, I'll zoom into the daily chart for you. Okay, on the pound Aussie, we've got this resistance line in here. What happened was the market broke through. It sold off massively. Okay, so it sold off through a structure level over here. Then the market came down, it came back, and it formed a resistance level. All right, so it's an area where the market has obviously rejected it. Now, you don't have to worry about identifying these levels, because ultimately that's what the Money File service is about. We're going to be identifying the levels for you. We're going to be showing you where we are looking to enter our trades. Then obviously it's up to you to go and do your own sort of analysis and decide whether you agree with that analysis and ultimately what you're going to do with it. So the market comes down to, it breaks through this level, it comes back to this resistance level here. It then sells off. We've now then put in a resistance level where we say, if the market gets back to this area, we want to look to enter. And there are a couple of ways that we can enter the trade. The first is from a candlestick reversal pattern. Now, the candlestick reversal patterns are typically played out on the time frame that we're doing the analysis on. So, for example, if we are trading, if we've done the analysis on the daily chart and it's a daily resistance level, then we would look to take the candlestick reversal pattern from a daily chart. Now, what the candlestick reversal patterns are, and there are only a few that we look at. There's a huge, massive books written by Steve Nissen on candlestick patterns that you can pick up and read if you'd like at some point, but typically there are only a few that we're primarily interested in. All right, and it doesn't matter what the names of them are. What we're ultimately looking for is we're looking to see that the market is reacting to a level. All right, and one of the best candlestick reversal patterns that we utilize is something called an engulfing pattern. So in an uptrend, in a downtrend, or where we're in a downtrend and the market pulls back to resistance, we're looking to trade a bearish engulfing pattern. All right, now what a bearish engulfing pattern is a candlestick pattern where the market comes up to a resistance level, it prints a bullish candle. Okay, then once it's printed the bullish candle, we then have a bearish candle, and the bearish candle, the body of the bearish candle, okay, being this thing here, completely engulfs the previous body of the bullish candle. And that's what we see here. And ultimately, forgetting what the name of the pattern is for a second, okay, what we're looking at here, if you think about it from a logical perspective, the market has come up to this level, okay? The buyers are trying to get through this level. They fail to get through this level, and then what happens is the market then sells off. And what we're seeing in this daily candle here is that the selling pressure in this daily candle is much, 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 much more than the buying pressure in this previous candle here. Hence, the body of this bearish candle completely engulfs the body of this bullish candle here. And then typically the entry that we'll look at. So once we get that candlestick reversal pattern, you can either enter as soon as the candle closes, or you can enter when the market breaks through that level. So once it gets through that low and then basically sells off, you can look to get in and sell at that level there. Okay, so that's what we call a bearish engulfing candle. You can also get bullish engulfing candles. So if you are buying from a support level, for example, and we say we're looking for a candlestick reversal pattern, you would be looking for a candle that looks like this. So you've got a very, very bullish candle at a predetermined level of support. You've got this bearish candle here, which comes down to that level. It doesn't break through it. And then the following candle is, the body is much, much, much bigger than the previous body. Hence, it's a bullish engulfing candle. And then what you would look to do is, buy once the candle closes or buy through the high of the candle. The stop losses, when we say that we're always looking to place them above a high or beneath a low, will always basically be behind the most extreme point. So where we took this trade over here, we place our stop loss above this level here. So above the most extreme point there, our stop loss was up here in around this region. Okay, so that's a bearish and bullish engulfing candle. I'll show you a couple more examples in just a few minutes. But I also want to show you what we call a 1, 2, 3 reversal pattern, which is what we also like to use to get into the markets. Now, 1, 2, 3 reversal pattern is ultimately, and this isn't the best example here. I will show you other examples. But basically, it's a pattern, it's a technical reversal. Because if you imagine when the market is, if we were in an uptrend, it prints a series of higher highs and higher lows, right? So it's always printing a higher high and a higher low. So 1, 2, 3 reversal is a pattern where the market goes up and it prints a high like it's done here. And this has to take place at a predefined level of support or resistance. Okay, so you can't just trade these willy-nilly all over the charts. It has to come at a predefined level. That's the only way you're going to get, a significant strike rate, a good strike rate. So anyway, the market comes up to that level. It then sells off from that level. It then gives another attempt to go up to that level. And this one's a bit of a weak attempt. I prefer them to come a little bit further up here. But then basically it fails to get through that high. So what you have is you got a high, you have a low, you then have a high. This one isn't as high as it could be, but you have a high all the same that's lower than the previous high over here. So if we accept that a trend is a series of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend, what do we have if the market then breaks through this area here? Okay, we then have a downtrend. So you have 1, 0.1, 0.2, which is the low, 0.3, which will be the high around here. Okay, so that's your 1, 2, 3. All right, so we've got a high, a low, a lower high. And as soon as the market breaks through that level there, that's where we look to enter our trade. Okay, as soon as it gets through that level there, that's where we get in on our 1, 2, 3 reversal. So 1, 2, 3 breaks through that. And that's our signal to get in. All right. And as I said, you prefer it to be a little bit more pronounced. You prefer to see a bit more of this sort of action here. So I'll try and find some other examples for you in just a few seconds. But hopefully that kind of demonstrates the idea. But ultimately, for all of our entry points, what we're looking to do is we're looking to buy or sell through a level. Okay, that's all. That's as simple as that. That's what we're looking to do. And we just use these patterns to help us identify the levels. So if, for example, you have your favorite entry technique, whatever that may be, please feel free to use that entry technique. Like the money file, what we're doing is we're showing you the trades that we're taking. All right, it's then your job to go away and decide whether they're trades that you like and obviously how you want to enter them. So tailor this to yourself. If you've got a favorite entry technique, utilize that. That's fantastic. That's what we want you to do. Okay, if you don't have a favorite entry technique, then obviously you can look at the sorts of entries that we take. All right, and furthermore, a couple of people asked us about basically using this on shorter term timeframes. Can you do it? Absolutely. So if, for example, we had highlighted this resistance level here for you in one of the money files, what you could have done if you're looking to trade on a short-term basis is you could have said, Well, okay, I'm looking at this area as being a resistance area that I would look to take a sell from if the market reacts to it. So then what you could do is drop down to an even lower time frame than the hourly, for example. So you could be on the 5-minute or the 15-minute time frame. You wait for the market to react to the level that we've shown you. Once the market reacts to that level, you then wait for your technical entry, which could be as simple as the market comes down, it consolidates on the 15-minute time frame. After that consolidation's over, as soon as it breaks through that level, you sell there, you stop above these swing highs there, and obviously, as you can see, the market then goes off and pays you really, really nicely. So we don't try and overcomplicate our entries, okay? We talk about it in the Forex Masterclass, so if you should have that if you signed up for the money file. I'd really encourage you to go and watch those videos there, because they will really show you a lot about the way that, not only the way we identify trades, but the way that we look to get into trades and all of that kind of good stuff, as I like to say. Let's go look at a couple of other opportunities before we finish this video. So another opportunity that we spoke about, we talked about, in fact, we talked about oil last week in last week's Forex Focus. Well, last week, depending on when you're watching this video. But we talked about a short oil trade. Now, how could you have played that? So we identified this level is a level of resistance. If we look at it on the daily chart, these are the sorts of levels that you can expect from us. We identified this level as a level of resistance. How could you have played it? Well, if you wanted to trade the candlestick reversal pattern, you could have waited for the market over here. It gets through that level. And then if I move this and make it bigger for you, you can see that we then have a bearish engulfing pattern at that level. So this bearish candle completely engulfs this bullish candle there. You would then be in with your stop above the highs, sell below the lows there on the break of that candle. Easy peasy. All right, so that's the candlestick reversal pattern. If you didn't want to do that, you could have looked for some sort of a 1, 2, 3 reversal on the 4-hour chart or on the 1-hour chart. And this example here will be on the 4-hour chart, on the 1-hour chart, sorry. So the market breaks through that high there. That's your first high. So that's your first high there. The market then comes down and prints a low over here. That's your second low. So that's number 1. That's number 2. And then the market comes up and tries to break the previous high, gets nowhere near. Okay, this is number 3. Then you would look to get in as soon as the market breaks beneath this low here. So you would be entering on a break below that level right there. Okay, that would be, so that's your 1, 2, 3. You get in on the break below that level there. You can either have your stop above this area here, or if you want to be a little bit more conservative, give the market some more room to breathe, you can then place it above these highs here. That's obviously your personal preference as to the way that you want to be able to manage your risk. Let's get rid of that. That doesn't need to be there. So that's your 1, 2, 3 reversal. And obviously, as you can see, you're then in there and the trade is paying you nicely. You had a similar opportunity on the dollar franc. The dollar franc on the daily charts, again, so if you're not going to look at it intraday or anything like that, on the daily chart, what we have here is something called a spinning top, okay? And if you want an overview of all of the different candlestick patterns that you can trade, please go and take a look at on the YouTube page where you're here right now, in our one of our playlists where we talk about all of the different technical analysis tools and things like that. There is also a video where we talk about candlestick entry. So go and take a look at that. There's some really useful information there. But anyway, what we have here is sort of like a spinning top. All right. So basically the market has broken through the top there. Looking at the logic of this trade here, the market's broken through this high, through the highs here. It's attempted to go above. So at one point in time, this candle was a very, very bullish candle. It was all green all the way up here. You had like this massive bullish candle. But the sellers were too strong. So even though you had all of these buyers involved here, you'd expect the market to whiz off all the way into the sunset. It doesn't manage to do that. The market then closes back below the candle. So you've got a very, very negative candle there. You would then enter when the market breaks beneath the low. You'll stop above the high and you could trade it down to the 100 moving average, for example. So very, very easy trade there. Really not too much to be worried about at all. So that would be your candlestick entry. You also could have taken a 1, 2, 3 reversal. So in this case here, the 1, 2, 3 reversal is the market breaks through the level, that's number 1. Comes down, prints a low, that's number 2. Prints the highs over here, number 3. Once it's printed that low, we're waiting for the market to break through this low here. So all you do is you basically wait for the market to get through. If I can put that in there. Get through that low. Once it gets through the low, that's where you're looking to sell the market. Stop above the highs here, or even above the highs there, and then you want to wait to see. Let's get rid of that. Sorry about this. Get rid of that. And then you wait to see where the market goes and pays you. And obviously, as you can see, it pays you really, really, really nicely. Now, the last entry technique that we use, and it's kind of fortuitous that it's fallen on this chart that we're looking at right now. So in the event that you miss one of the reactions, so let's say you've missed the candlestick pattern or you've missed the 1, 2, 3 reversal, you can then take pullback trades. And what the pullback trade is basically once the market has sold off from a level or rallied from a level in the case of it being a support. Okay, once the market has sold off from that level, you can then wait for a pullback in the price action, which we get here. And if it pulls back to a previous structure level, then all the better. So the market's broken through this level, it's pulled back to this area here. So previous level of support becomes resistance. You put in your trend line there. You wait for the market to break the trend line. Once it's broken your trend line, we typically wait for it to then break through another candle, which we have here. So another sort of mini low, if you like, which you get there. So you get in beneath that level, stop above the highs, and that allows you to get in on sort of like a trend continuation pattern, if you like. Okay, so I hope you found value in this video. As I said, you know, you've obviously got the Forex Masterclass. Please go and take a look at that. Look at all of our technical entries and exits and all of our technical lessons on YouTube right here. You have this video. So that's basically the best way to be able to utilize the MoneyFile service. There are going to be, as I said, there are going to be many occasions where because we're giving you the information a week in advance, we can't give you the exact technical setups that we're going to take. But now in this video here, I've shown you the types of technical setups that we are taking. So it's just a question of paying attention to the levels that we identify you and then trading accordingly. Okay, so thank you very much for watching this video. I hope you enjoyed it, and I really and truly hope you enjoyed the MoneyFile service. If you're watching this video and you haven't signed up for the MoneyFile service, I'll post a link beneath the video. Click that link, go and check it out, see if it's for you. Otherwise, thank you very much for watching. Happy trading, and I'll speak to you soon.